Hello, I'm Tammy with your Week in Forex from MaxiForex. Today we will take a look at last week's market highlights. As 2009 comes to an end, we thought it would be worthwhile to review the year, as well as make predictions of what 2010 may bring us. The dollar rally continued, although its pace slowed down a bit as we received worse than expected economic data, such as GDP, new home sales, and the University of Michigan Confidence Index. And now for a closer look at the markets, we're joined by foreign exchange analyst Martin Smith. Welcome, Martin.
Hi.
Is this the first sign that the dollar rally is about to end?
I don't think so. Firstly, the trading we saw this week is typical of the trading we saw when there is less liquidity in the marketplace. And secondly, we had further confirmation that we're returning to more standard market correlations, where bad economic news is bad for the dollar and vice versa. And lastly, if you gauge the greenback's performance starting at the beginning of this rally, well, only the Canadian dollar has gained strength amongst the G10. And the next best performing currency is the Kiwi, which is still down more than 2% over just the last 3 weeks.
This obviously was a tumultuous year for equities. Just this time last year, last January, we were still in financial crisis mode. The Dow Jones Industrial Average was holding around 9,000. How did all of these things impact the dollar?
Well, we saw the Dow Jones Industrial Average bottom out in March, just below 7,000. Now, normally, a weak equity market will mean a weak currency. But the US equity market was simply representative of worldwide financial fears. Now, obviously, fear is worth more than equity because at that very same point in time, the dollar index was trading near 90.
So investors flocked to the most secure investment that they could find.
Yes, it was one of the few investments actually rising while other markets were crashing. It's the law of supply and demand.
It seems like overnight the dollar just started to weaken from that point.
Well, central bankers did an outstanding job at keeping the financial systems not only afloat, but highly liquid. Well, so liquid, in fact, that they started to dilute the power of the dollar. Similar to corporations who issue new stock, it dilutes the value of existing shares. Supply outpaces demand. Confidence slowly returned to the marketplace, and investors started selling their dollars in favor of higher-yielding currencies, so the dollar started to slide.
This caused commodity prices to inflate, in particular gold.
Yes, the gold rush of 2009. A rather interesting move within the market, that. I mean, when Bear Stearns collapsed in March 2008, gold shot up, I think, over $1,000, as you'd expect. Now, when Lehman filed bankruptcy in September 2008, gold barely scratched $900. By March 2009, the equity markets were collapsing and gold was retesting all-time highs.
But will gold continue to advance?
Well, I think there are three catalysts here. First of all, there's residual fear. Secondly, there's a weak dollar. And thirdly, there's demand. Now, demand is due in part to the first two. Fear of a double dip, and a weak dollar, which causes commodity prices to appreciate. And demand, well, which was created as people the world over started accumulating stockpiles of the precious metal. So I believe higher gold prices are here to stay.
So what do you think 2010 has in store for us?
Well, I'll answer that question with a question. Is the worst definitely behind us? Well, the quantitative easing and stimulus programs are a band-aid, and a band-aid in itself, of course, is not a cure. Rather, it buys time for healing to occur.
So, do you think the worst is behind us?
Well, recent data is certainly suggesting that is the case. I mean, I think the recovery will be slow, but now that the dollar has turned the corner, we can expect to see further dollar strengthening. I do believe that the next major hurdle, in fact, is whether global central bankers agree on when and how much to unwind the quantitative easing facilities. And that, of course, will lead to exaggerated volatility in the market as it becomes every country and currency for themselves. Equities will appreciate at a much slower pace, and volatility will be most prevalent, I think, in the bond and currency markets, as interest rate moves will rule the show.
Well, thank you, Martin, for joining us once again. Until next week, I'm Tammy, wishing you a prosperous new year. Be sure to visit us at maxiforex.ru.